Welcome back to the Deep Dive. Today, we are lacing up to take a deep sprint into the official financial report from Nike, Inc. This is for their second fiscal quarter, which wrapped up back on November 30, 2025. We've got the full stack of documents here, the earnings release, all the management commentary, and our mission really is to decode what feels like a fascinating paradox. Because on one hand, you have the CEO, Elliott Hill, talking about this strategic turnaround. He's describing the company as being in the, and this is a quote, middle innings of our comeback.
It all sounds pretty positive, right? They're talking about win now actions, realigning teams, that kind of thing.
It does sound like momentum, but then you actually look at the financials and you see a company that's, well, it's running extremely hard just to basically stay in place. Let's just set the stage with those core headline numbers for you. Overall revenues were $12.4 billion.
Okay.
And that translates to, a tiny 1% increase. It's actually flat if you strip out the currency fluctuations. So stability. Stability at the top line. That sounds pretty reasonable for a company that says it's in comeback mode. But this is the aha moment. This is the thing that sets the tension for our whole deep dive today. Despite that flat revenue, net income just plummeted.
Plummeted is absolutely the right word. Net income dropped a shocking 32%, landing at just $0.8 billion. And diluted earnings per share, same story, down the exact same 32% to $0.53. So our job here is to figure out what's going on. What drove that tiny, tiny revenue increase and what absolutely crushed their profit margin?
The CFO, Matthew Friend, he mentions the resilience of our portfolio, but then he also talks about managing headwinds from repositioning our business. And I think as we start to unpack the channels, we see exactly what was resilient and what was hit by that headwind.
That's the perfect way to frame it. The resilience part, that's really clear when you look at their traditional distribution. For years, the big story's been direct to consumer. Everyone wants to bypass the middleman. But for Nike in this quarter, their stability came from the exact opposite direction.
Okay, let's get into this tale of two channels because it really does expose a big tactical shift. So traditional wholesale revenues, we're talking selling through partners like Foot Locker, Dick's Sporting Goods. That was a surprise winner. They hit $7.5 billion. That's up a really robust 8%.
8%, and that's both reported and currency neutral, so it's a real number.
And the source material says this is primarily coming from North America. So they're leaning really heavily on those old school retail partners to move product.
That 8% wholesale growth, that's the resilience engine. But here's the context you have to remember. Wholesale is the low-margin channel. You move more boxes, sure, but you make less profit on each one. The big problem, the headwind, was the part they've been championing as the future.
Nike Direct.
Nike Direct. It came in at $4.6 billion, and that was down 8% reported, or even worse, 9% currency neutral. And when your direct channel suffers, your bottom line just suffers disproportionately. A dollar of direct revenue is worth so much more in profit.
Wait, I want to drill down on that. Because they're talking about a comeback, they're talking about digital transformation. But the heart of that direct decline was a huge 14% decrease in Nike brand digital revenues, a double-digit drop in your highest margin, most important strategic area. That has to be the most worrying sign in this whole report, doesn't it?
Absolutely. That 14% drop in digital, that is an existential question for management. This isn't just a quarterly hiccup. It suggests their whole digital ecosystem, the apps, the personalization, everything they've invested billions in is just not hitting the mark right now. And that pain was, it was compounded by a smaller 3% drop in their own Fiscal stores, too.
So we have this strategic paradox. They only got growth by relying on their old business model, wholesale, which means sacrificing margin. And that 8% growth in the low-margin channel still wasn't enough to make up for that devastating decline in the high-margin digital channel. It feels like their main engine is threatening to stall out, so they're having to pump fuel into the less efficient backup engine just to keep moving.
That is a perfect analogy. That shift in the channel mix. More low-margin wholesale, less high-margin direct. That's the first huge driver of that 32% net income drop. And that's before we even get to costs.
Okay, so let's transition. We've talked about how they sold the product. Let's talk about where in the world they sold it. Since we know wholesale in North America were kind of the winning combo, let's see if that worked everywhere else. Let's pivot to the geographical breakdown. And the story really is centered on the home turf. North America drove almost all the global growth. I mean, it performed remarkably well, with total revenues up a powerful 9%. And that growth was broad, too. Footwear up 9%, apparel up 7%. When they talk about resilience, they are 100% talking about the North American customer.
They are. But that strength in North America was almost completely wiped out by the drag coming from the single biggest growth market in the world, Greater China. That region saw just a devastating revenue decline of 17% on a reported basis. It's about 16% currency neutral. Just think about that reversal for a second. China is supposed to be this massive engine for Nike. To see a 17% drop, that is not a blip. It's a major market contraction. And look at where the pain was. Footwear down 21%. Equipment, so balls, bags, everything else down 25%. This suggests the brand is facing some really deep headwinds there.
That's just a brutal anchor on global performance. I mean, even if North America is flying high, plus 9%, a drop like that in China just puts immense pressure on everything. What about the rest of the world?
The rest of the globe didn't exactly pick up the slack. You look at Europe, Middle East, and Africa, EMEA, revenues there were up a modest 3% reported, but once you take out currency effects, it actually went slightly negative, down 1%. And Asia Pacific and Latin America, APLA, basically the same story, down 4%.
So the global picture is crystal clear. It's North America versus the world this quarter. North America delivered, but it was just compensating for weakness everywhere else, especially that huge retreat in Greater China.
And we can't ignore the other brands. I mean, the subsidiary brands add another layer of complexity to this whole comeback story. Take Converse. Converse revenues were just $300 million. That's a decline of 30% reported, and a really brutal 31% currency neutral.
31% globally. That's almost a third of the business just gone year over year.
It is. And what's really concerning here is that while the main Nike brand found a working strategy somewhere, North America via wholesale, Converse found no safe harbor anywhere. The report specifically notes the decline was due to losses across all territories. So this suggests the brand itself is facing a major product or relevance issue, something separate from the distribution problems plaguing the main brand.
Okay, so we've established the revenue story. North America is carrying the weight, China's crumbling, and the high-margin digital channel is failing. But all that really only explains why revenue growth was flat. It doesn't fully explain that devastating 32% drop in net income. So to understand that, we have to dive into the cost side of the equation. And the first place to look always is gross margin. This is the profit they make before any administrative costs. And that key metric decreased by 300 basis points, landing at 40.6%.
Let's just put that 300 basis point drop in context for you. That sounds technical, but 300 basis points is 3 full percentage points. So if they were selling a pair of $100 shoes, they are now making $3 less in gross profit than they were last year. That kind of erosion just fundamentally changes everything.
And the report is unusually direct about what caused this massive margin destruction, which is really insightful.
It really is. They state, and I'm quoting here, this decrease was primarily due to higher tariffs in North America. This is just a huge, unavoidable external factor. They're importing goods into their most successful market, and, well, geopolitical policy is jacking up their costs before the product even gets here.
And you can see that tariff impact elsewhere, too. If you look at their inventory, which is always a good sign of supply chain health, inventory units were down 3%, which is good. They're clearing old stock. But they say the reduction was partially offset by increased product costs, primarily due to those higher tariffs. So even with less stuff on the shelves, the stuff they do have is more expensive.
And if you connect this margin squeeze back to the CEO's comeback talk, you can see them making some really deliberate choices about spending to fight back. Let's look at their selling and administrative expense, SG&A. It was up 1% overall to about $4.0 billion. But inside that number, they made two very strategic and almost contradictory moves. First, demand creation expense. That's all your marketing, your ads, your sports endorsements. It increased by a massive 13% to $1.3 billion. They are pouring money into marketing to fuel that comeback.
So they're making a strategic bet. They're saying, okay, profitability is suffering now because of tariffs, but we are going to spend heavily on the brand to make sure we keep market share and drive sales in the future. Yep. They're trying to outmarket the economic pressure.
Exactly. They're opening the wallet for their big campaigns, for their big athletes. But to balance that huge marketing splurge, the second move was cutting fat somewhere else. Operating overhead expense was actually reduced by 4% to $2.8 billion, and they say that's mainly due to lower wage-related expenses and just lower administrative costs.
And that's the tension right there, isn't it? They're cutting corporate staff and admin costs to fund a massive 13% increase in marketing spend. It shows a management team that is ruthlessly prioritizing brand power over internal efficiency. They think the fight's going to be won in the marketplace, not in the back office.
And then there's one final little thing that just chips away at that net income number, the tax burden. The effective tax rate went up to 20.7% from 17.9% last year. Now, that's a small difference, but it's another headwind. It means the profit they did manage to earn was taxed at a higher rate. It was just a perfect storm of cost pressures.
So what does this all mean for you looking at these Q2 results?
Well, the story is one of transition and, frankly, one of pain. The company is only stable on the top line because they leaned really hard on their low-margin wholesale partners and the strong North American consumer. But that came at a huge cost. A big strategic failure in the digital channel and that overwhelming pressure from North American tariffs. And to put that pain in really clear terms, just look at EBIT. That's earnings before interest and taxes. Total Nike brand EBIT was down a punishing 21%. And remember, converse, its EBIT was down a staggering 108%, which means that brand operated at a loss for the quarter. The struggle is portfolio-wide.
But despite all of this staggering drop in income, the company is signaling confidence to its shareholders. They returned about $598 million to them through dividends, which is actually up 7% from last year, and they were very quick to point out this is their 24th consecutive year of increasing that dividend payout. So the message is, hold tight, this is temporary, we're committed to the comeback.
That is definitely the message. But here's the provocative thought for you to consider as you digest all of this. We started with management talking about headwinds from repositioning our business. You know, that phrasing, it implies the problems are largely internal and strategic.
Right, but the report itself explicitly names the higher North American tariffs. That's an external geopolitical force they don't control as the primary driver for the gross margin decline.
Exactly. So how much of that 32% profitability drop is truly because of internal risks they can control? Like, say, they're struggling direct-to-consumer strategy. And how much is because of these external macroeconomic forces like tariffs that they just have to absorb?
And that balance, that really determines how quickly their comeback can actually succeed, doesn't it? If those tariffs stick around, they have to execute perfectly on their internal strategy just to get back the ground they lost to geopolitics. The margin for error is just incredibly slim going forward.
The strength of their wholesale partners and the loyalty of the North American customer, that bought them some time this quarter. But the clock is absolutely ticking on fixing the digital problem and the China problem, all while paying those steep import taxes.
A fascinating tension to watch in the coming quarters. Thank you for diving into the sources with us today.